Assalamualaikum warahmatullahi wabarakatuh. Welcome back to our discussion on the use of murabaha financing in Islamic banking. I was mentioning earlier that most of the Islamic banking transaction using murabaha financing do not involve the real purchase of the subject matter from the supplier to be sold to the customer on credit basis, except for tawarruk, where there is a real sale of the commodities, from the vendor to the bank and the bank to the customer. But in places where tawarruk are not used, then the bank will use murabaha financing, and this is where I am trying to address the issue of the bank not being able to practice the true murabaha because of the high capital requirement accorded to that sort of transaction. If you look at the diagram over here, when the Islamic Bank was first set up, in the early 70s and 80s, they were set up as a commercial bank, and as a commercial bank, the funding of the commercial bank is not coming from capital fund. So meaning that commercial bank do not use capital fund to make loan, but they basically borrow from the depositors to make the loan, right? So the leverage ratio of 3 accorded by Basel committee, meaning that for every $1 of loan, the bank need to hold a minimum of 3 cents. So that is a leverage ratio of 3%. But when we take risk into the lending, then the capital adequacy ratio is 10.5%, meaning that it is higher than the leverage ratio. For every $1 of loan, the bank need to hold 10.5 cents of their own capital, right? So from the very beginning, the Islamic banking business have been adopting the conventional banking business, where the source of funding is not coming from capital fund, but it is coming from debt. So that is why I'm saying that Islamic banking, as a highly leveraged business, will find it very difficult to use the al-bay' as prescribed by the Quran, because the bank will be using borrowed funds to extend the murabaha or to make the murabaha, right? The bank is not using their own capital fund to extend the murabaha, but they are using borrowed fund coming from deposit, coming from wadi'ah deposit, qardu deposit, and mudarabah deposit. But all of these deposits are debt fund. They are not al-bay'. They are not, they are not al-bay' fund, but these are debt fund, which is an IOU, and therefore, that will have a very big implication towards the financing side. So the issue here is when the funding of the loan or the funding of the murabaha is coming from debt. It's not coming from the banking capital. It is coming from other people's money. Then, there is a tendency for the bank to be unethical. To be meaning that it is not our money, it is their money. So what the heck, So that's basically the idea, and this is very dangerous, and therefore we have regulation come in to control the so-called toxic or irresponsible behavior of bank who may abuse their position of their position in making loans. Right? So this moral hazard and irresponsible lending, or lending to their business partner or lending to their family members, that would eventually lead to default, this need to be controlled, or this need to be eliminated through regulation, right? So banks are required to hold adequate capital against the loan or against the murabaha. So any sort of lending or any sort of murabaha extended, by using the deposit fund must be supported with adequate capital. So meaning that the more risky the loan, so if the loan is not secured or it is clean without collateral, then it is a more risky loan, and therefore more capital is needed to support the loan. Likewise, if the murabaha is a true murabaha, and therefore when the bank undertake a true murabaha, the bank will be putting the asset on their banking book. That will imply that the bank is the owner of that asset and will be responsible for any loss from the decline in asset value, because once the bank is the legal owner of that particular object, anything happening to the object, the losses of which the bank will have to absorb, right? So the more murabaha, the more object financing undertaken, the more capital needed by the bank to support this so-called risky exposure. So this kind of modality is not suitable for al-bay', as it requires a big amount of capital to sustain that sort of business modality. And that is why many Islamic banks try to evade or try to prevent themselves into doing through sale or through leasing, because they simply do not have enough capital to support the risk. And for that matter, many banks have resort to selling object it does not own, through the use of some legal devices or some legal stratagem, in order to ensure that the bank will be able to sustain their business, to make murabaha, and therefore able to generate revenues. But these murabaha are not the true murabaha. And when the bank continues to resort into using this modality, selling asset it does not own, then they will be exposed to many Sharia non-compliant risk event and potential litigation, by customer. And this is a very sad and disappointing situation for the Islamic banking sector, because the Quranic prescription of al-bay' over riba is a revolutionary, and potent system to combat riba, because riba is unjust, riba is zulum, and therefore when al-bay' is prescribed over riba, al-bay' is a better system, is a much more equitable system that can generate a lot more balance in the Islamic banking transaction. But as for now, because we have started from a false beginning, meaning that we have started as an Islamic bank that rely on borrowed funding, and this is how we have not been able to realize the use of al-bay' in the banking system. Hopefully, when the Islamic bank can come and try to promote the use of investment fund system to finance the al-bay' transaction, that will be a much more workable model, which we hope we can discuss further in the coming videos. Thank you very much. Please, don't forget to comment and share and to subscribe. I will see you again. Assalamualaikum warahmatullahi wabarakatuh.